All right. So we are coming to look at the IAS 33, which is the earnings per share. Okay. Okay. So earnings per share. All right. So why the earnings per share and what is the basic idea about the earnings per share? Okay. Let's let's say that a company has in issue 20,000 shares. Okay. Okay. And they issue 5,000 shares on July 1. Okay. So the profit for the year or the profit attributable to the shareholders is, let's see, let's see, the profit is 50,000. Okay, 50,000 Ghana cedis. Okay, let's come to this side. The 20,000, the 20,000 shares, the contribution to the profit, is it the same as the 5,000 shares? The 20,000 shares at the beginning of the year, its contribution to the profit for the year, and the 5,000 shares that were issued on July, their contribution, are they the same? Their contribution to the profit for the year, are they the same?
No, because of the time.
No.
No, they are not the same.
They are not the same, isn't it? All right. This will
Yes, sir.
contribute for 12 months, isn't it? Full year. But this will contribute to only 6 months of what? Of the profit, isn't it? Okay. Or the idea is that this 5,000 will only generate profit for what? For 6 months. Okay, so if you are generating profit for 6 months, what portion of the shares will be generating the profit for the 6 months? We need to match the what? The shares contribution against the what? The profit. So what we do is that this share will now be what? We find 6 months of that particular share and match it against the what? Its contribution in the profit. That is the idea about the earnings per share. People cannot be in the company for a year. You just came in for 3 months. You'll be expecting to have the same what? Shares that will be arranged for dividend payment like them. No, they have contributed to the profit for a year, and you have contributed only 3 months. So your share of the profit or your contribution to the profit should not be the same as their contribution to the profit. That is the idea about the what? The earnings per share. So we match the contribution against what? The shares. We match the contribution against the what? The shares. That's what we are coming to do. The earnings per share. All right. The standard gives two types of what? Two types of, I don't know how I'm going to say it, two types of calculation under the what? The 33. Okay. So we are going to be looking at what we call the basic earnings per share. We are going to be looking at what we call the basic earnings per share. Okay, the focus will be on the basic earnings per share because that is where most of the problem is. Then we look at what we call the diluted earnings per share. Earnings per share. So that the basic earnings per share is the present earnings per share or the current earnings per share. Okay. This one reflects the actual things that are happening currently. But a diluted earnings per share, there are some instrument that will be converted into into equity shares in the future. If those conversion are done, what will be the impact on our current earnings per share? That is the idea about diluted earnings per share. So we'll be looking at convertible instruments. So the company might issue convertible instruments that they are saying that the holders have the option to convert the instrument to equity instrument at this date. So we stand today to say that, okay, assuming this particular instruments are being converted in the future, what would be the impact on our earnings per share at that time? So we just look at those possible issues that are going to be reducing our earnings per share in the future. So we just estimate the impact of those instruments on the current earnings per share. So that is about a diluted earnings per share. But this one we normally use the dilutive instruments. Some of the instruments, they will not be reducing the earnings per share, but they might be increasing it, which we call the anti-dilutive instrument. So we always use those instruments that is going to reduce our current basic earnings per share. But those that are going to be increasing it, we ignore because we want to know the negative impact on the current earnings per share. So we'll be looking at the current or the basic earnings per share, which is in today's term, which is what is actually happening on the ground. What is actually happening on the ground. Okay. So the basic earnings per share or the issues that will be happening on the ground right now, what can impact the basic earnings per share, which you always be seeing as which you be seeing as something like this: basic earnings. Okay, it will be here, basic earnings per share. Okay, so let's come to the basic earnings per share. Okay, what is going to impact the basic earnings per share? All right, what is going to be increasing our shares is what we are going to looking at there. What is going to impact the basic earnings per share? There can be new issues. Okay, there can be new issues at full market price. Okay, so we'll be looking at new issues at full market price. So the company can issue additional shares at full market price. Okay, the company can also do what we call the bonus issue. Okay, our shares can also be increased by converting our reserves into equity shares. So that will also be an issue. We can also look at the issue of right issue. Okay, the right issue, a situation where the share will be issued to the existing shareholders in the proportion of their shareholding, but this will always be issued at a price lower than the current market price so that it can encourage them to purchase. So these are the things that can increase our current shares of the company. So we'll be looking at that one by one. So the new issue at a full market price, there's no problem with that. The only thing that we do is that we prorata the weighted average shares of the entity. Bonus issue, it has no effect. As soon as a bonus issue is being issued on existing shares, we assume that the bonus issue has been in existence for the time the company has the company started operating. Okay, we are converting reserves to shares. The reserves has been there, so we just said that okay, in effect, the shares were in the bonus issue, but just that we are now coming to we are now coming to materialize it. So the bonus issue will be assumed to be in existence from when the company has been incorporated. If that is on existing shares. If it is on existing shares, we assume that the bonus issue has been in existence from the time that those shares have been issued. Okay, but if you come to a right issue, the right issue will be done mostly at a discount. So if we are issuing shares at a discount, it means that portion of it will be bought at a full market price. Portion of it will be what? Will be a bonus issue. So right issue will always come with a bonus issue and market what? Value. So they are going to pay for some, and some of them they are not going to pay for it. Okay, so we'll be looking at how to separate the bonus issue from the right issue. But we'll be doing that today. Okay. How is the earnings per share calculated? Okay, how is the basic earnings per share or earnings per share itself is calculated? It is calculated as earnings attributable earnings attributable to earnings attributable to ordinary shareholders divided by the weighted average number of shares. Okay, divided by the weighted average number of shares. Weighted average number of shares. Average number of shares. Okay. But if you are doing this for a parent company, the parent company will be the profit for the year, the profit attributable to the parents. So the earnings per share will be calculated for only the parents. It's the parent that want to calculate the earnings per share. So NCA will not be part of that. Okay, divided by the weighted average number of shares. Weighted average number of shares. Okay, the earnings per share is always calculated in the highest denomination of the currency. So if you are getting 0.2, you change it to 20 pesos. Okay. If you are getting 0.2, you change the 0.2 to 20 pesos. But if you have 2 cedis already, you leave it like that. So it should not be calculated in maybe decimal 0.2, 0.8, no, 0.5, no. If it's 0.5, you change it to what? Ghana what? Cedis. But it's already, you change it to pesos. But if it is already in cedis, which is higher than 1, or maybe 1 cedi 50 pesos, you leave it 1 cedi 50 pesos. Okay. But the question is, what constitutes the what? The earnings to the ordinary shareholders. Please, whenever you are giving preference shares and it is cumulative preference shares, when it is redeemable preference shares, these preference shares are treated as debt instruments under financial instruments. Okay, we look at financial instruments already. So if the shares is cumulative, if the shares are redeemable, preference shares, if they are redeemable, they are cumulative, they are treated as debt instruments. So their dividends are treated as part of the finance cost in the profit or loss account. So dividends on redeemable preference shares, cumulative preference shares are already taken away from the profits. But those dividends on irredeemable preference shares, not cumulative preference shares, those are the dividends that will be treated in the statement of changes in equity. So those are the dividends that we are here to what? To take from what? From the profits. So it will be the profits for the year minus irredeemable preference shares dividends, non-cumulative what? Preference shares dividends. Because those dividends are treated, the instrument itself are classified as equity instruments. They are treated as if they are equity instruments. So you should be very mindful of which class of dividends you'll be taking away from the profits. Dividend for redeemable cumulative, they are treated as debts, and their dividend payments are treated as finance costs. It is only redeemable, it's only irredeemable and non-cumulative preferred dividends are treated in the statement of changes in equity. And these are the figures that you'll be taking away from your earnings before you come to your earnings per share calculation. All right, so that is it. Let's come to issue at a full market price. So if there is an issue at a full market price, okay, I've done example over here. So let's use this example to calculate. Okay, let's use this example to do our what? Our demonstration for the issue at a full market price. Issue at full market price. Okay, so shares outstanding, that is what they will be telling you, or shares in issue. So shares in issue was 20,000 shares. Please, our focus is on the number of shares, not the value of shares. So they can give the value of shares. You have to change it to the number of shares. We are going to be looking for the number of shares. Okay. So this will be given to you at the beginning of the year. Then they will say July 1, there was a new issue. That is a full market at a full market price. So there's no bonus issue. There is no any issue there. So we have the new issue to be 5,000 shares. 5,000 shares. Then we have the profits after tax, or the profit for the year to be 50,000. Okay, so let's calculate our earnings per share, our basic earnings per share. Okay, so calculating our basic earnings per share, we know that our basic earnings per share is calculated as what?
Profit over total number of shares.
So we have
Profit after tax.
profit after tax over our WACC. Okay, the WACC is the weighted average number of shares. So
Weighted average number of shares.
So let me just write something like this. Okay, so our basic earnings per share will be equal to the 50,000. But the number of shares will not be 25,000. No, because their contribution to the profit are different. So let's calculate our weighted average number of shares here. Okay, some people they have a way of calculating this. Please don't go and confuse yourself. All right, don't go and be doing that. Okay, the first year will be the first shares 20,000. You are going to find 6 months. Then the 25,000 for the remaining year will also do 6 months. Okay, if you are doing that, you are going to be confusing yourself. But if that is the thing that works for you, fine. I don't have any problem with that. Okay, the first 2,000 will do 6 months. That is January to June. The last 25,000 will now do 6 months also. That will be July to December. That is fine. Okay, but you have to learn a new thing. Okay, the 20,000. How many months will the 20,000 do? It will do a full year, isn't it?
Yes, 12 months.
So you just do your January to December for the first one, which will be 20,000. So this will do a year. So if you multiply by 12 over 12, you still be getting the 20,000. So that will do a full year. Okay. So let's count to our third. But from July to December, the new shares that we have issued, it will do how many months? The 5.
6.
Okay.
Uh,
So
6 months.
6 over 12. So we are getting what? What will be the total?
2,500.
2,500 rather. Sorry. It's supposed to be 2,500, not. So we have 2,500. What will be our total number of shares?
22,500.
22,500.
Okay. 22,500. Okay, so if you also try the other one where 2,000 will do 6 months times 6/12, 20,000, you'll be getting 10,000. Then you come here, 25,000 will do additional 6 months. You'll be getting 12,500. Okay. So, but this is something that you see, sometimes you don't know what to do. But just ask yourself which amount the shares that you have, which one amount then will do a full year, will do a contribution for a full year. That will be for a full year. Then which one that will not do the full year? That is the one that you are coming to pro rata. Okay. So that is a new way of, so maybe you can go with the one that you are going to like. What would be the earnings per share?
.22 Ghana cedis per share.
Okay. So we have 2.2 per share. So you can just write per share here. Okay. That is your earnings per share. Okay. Let's count the so that is example. Let me see whether I have example on that so that we can solve a full market price question then. Okay, let's look at the question number 1. That is a full market issue there. Okay. Okay, someone should take the question number 1 for us. All right.
A Limited has earnings of 300,000 Ghana cedis during the year ended 31st December 2016. On January 1, 2016, A had share capital of 100,000 Ghana cedis, 100,000 1 Ghana cedi per share. On 1st March 2016, a further 60,000 shares were issued at 3 cedis 25 pesos per share. Calculate the basic earning per share.
Okay. All right. All right. So that is it. What is the earnings for the year? Okay. So let me come here.
300,000.
So question number 1. Okay. A Limited. A Limited. Okay. So the earnings for the year is 300,000. Okay. So shares in issue or shares at the beginning of the year. So you look at the shares in issue. Shares in issue was 100,000, isn't it?
Yes.
Market value issue. So the market value issue was how much? At which date? Okay, 60,000 at 1st March. Okay, 60,000 at 1st March. Okay, so let's calculate our basic earnings per share. That will be the earnings for the year divided by our weighted average number of shares. So your mostly you only be calculating the weighted average number of shares. But sometimes they can also give you the irredeemable preference shares and those things. So you have to take their dividends away from what? The profit. The profit that will be given to you will always be the profit for the year or the profit after tax. So you have to take their dividend from it. Okay. So let's calculate our weighted average number of shares. Okay. So let's go to the question there. Okay. So which of these shares is going to contribute to the profit fully for a full year?
The 100,000.
Okay. So the 100, the 1 cedi over there is the what? The value at which the shares have been issued at the time that they have. So that is the par value. Okay. But the price of the shares at this date, it's what? This is the actual share price. Okay. That is the actual share price. So we have January to December. The January to December, we have the 100,000. So this one, you can even decide not to what? Not to do anything, because you will still be having your 100,000. That will do a full year contribution to the profit, 100,000. Okay. But let's come to March to December. Okay. The new issue will do how many months contribution to the profit?
10 months.
Okay, that will be 10 months. So we find 10 months of the shares. Okay, so we have that's 60,000 multiplied by 10 over 12. Okay, someone can find 2 months and take it away, because the first 2 months, the profit generated for the first 2 months, these shares were not there. So we just find 2 months and take it from. Okay, what are you having?
Five 50,000, sir.
Okay, 50,000. So 50,000. So our work will now be what?
150,000.
Okay, 150,000. Okay, so our earnings now will be 300,000 divided by the 150,000 shares. Would that give us 2 cedis?
Yeah.
Okay, so we have 2 cedis per share. Okay, so for the market value, there is no issue there, but you just look for the shares contribution to the profit. The profit that will be given to you will be the profit for the full year. So only the shares that are going to be there for full year will be arranged for the full year dividends, but your own will be for only 10 months. So that should also be reflected in the earnings per share. So you do only 10 months of that, and that is it. Let's come to bonus issue. Okay. So we have bonus issue, or maybe we have the strip issue. So you can see bonus issue, or you can see, so we have bonus issue. You have the strip issue. And also maybe you see something like split. So share split. So you'll be saying share split also. How do we treat them? So share split, or we also have the stock split. Okay. So the bonus issue is going to be converting. So another name for the bonus issue is the script issue. Okay, bonus issue is we are changing our results, our retained earnings to shares now. So the retained earnings, when we are changing our retained earnings to shares, it means that the idea is that the shares value has always been in the retained earnings, but we are just trying to make it happen now. So the bonus issue will be assumed that it is starting from the time that those shares has been issued. So for the bonus issue, it doesn't matter when, as far as, so if we have the earnings, and the shares in issue for 100,000. These are the shares that we have from the beginning. So the question says that maybe on 1st November, the company made a bonus issue of 142. It means that you bring 2 of your existing shares for 1 new. The company made a bonus issue of 142. Okay. Since these shares were at the beginning of the year, we assume the bonus issue has also been from January, or from the time that these shares has been issued. So the bonus issue, since it is on the share that is starting from the beginning, we don't actually pro rata. So it is the bonus issue is also at the beginning of the year, January. But it will start from the time that this shares has been issued. So you might see earnings per share for the previous year. You have to go and what and adjust it with a bonus issue, because we assume that the bonus issue has been in existence from the time that the 100,000 shares were issued. But last year you used 100,000 shares to calculate your earnings per share, which is strong because the bonus issue is not taken into consideration. So you go and adjust that particular what profit, okay, or that particular earnings per share. But the question is, if the bonus issue is on the market share, okay, these shares were issued from when?
July.
No, the one that we have done is March, 1st March, isn't it?
Okay, March, yeah.
Okay, so
That's
the bonus issue for them will also start from what?
From March.
It will start from March. Okay, so the bonus issue will start from March. So it means that their bonus issue element over here will be pro rata, because it will start from March, not at the beginning of the year. The shares were not there at the beginning of the year. But the bonus issue for the first year, they have been there at the beginning of the year. So it will be a full year, no apportionment. But if you count to the new share, which is what? 1st March, bonus issue will start from then at the time that what they have been issued. That will be what? 10 months. So if the bonus issue is 142, you are bringing 2 of your shares for 1 new. Okay, so the bonus issue will now be 1/2 multiplied by 60,000. So the bonus issue on them will be 30,000. So what we have is that the shares itself that we have issued plus the bonus elements, that will give us 90,000. Then we now multiply the answer by 10/12. But for this one, it will be 150,000 straightforward, because the bonus issue will be for a full year. They have been there from the beginning of the year, so that will be a full year for them. Okay, so I will also
Can you go over the bonus issue for me, please?
all right. So I'm saying that bonus issue, whenever a bonus issue is on existing shares that have been in issue for some time now, we don't actually what do 12 over something or 3/12. No, if the shares are issued from the beginning of the year, the bonus issue will be assumed to be in existence from the beginning of the year. We don't do anything to it. But if the shares are issued from July, the bonus issue will be on that particular share from the time that they have been issued. That will be from July to December. All right. So let's come to, okay, how do we treat the share split?
Hello.
Yeah, I can hear you, Sina.
Please, the 142, the example you just made, the 142, is it not that the shareholders are bringing 1 to take 2, or the company is giving 2, the company is giving 1 to the shareholders, while the shareholders are bringing 2?
Sina, are you asking a question? Because I see
Yes,
it's more
please.
like you are doing suggestion.
Oh no, it's a question I'm asking. So the 142, if you can go over that one, I'll be
Okay.
glad.
The 142 is the bonus issue is 1, but we are giving you 1 for 2 of your existing shares. So bring 2 of your shares for 1 new. That is the meaning of the 142. So the bonus issue is the 1. So we are going to, if you are having 2 shares, we will give you 1 bonus issue for what? 2 of your existing shares. So 1 for 2. Bring 2 of your existing shares, or for every 2 of your existing shares, you are going to be getting 1 as a bonus. That is the meaning. So 1 for 2. So bring 2 of your existing shares for 1 new. All right.
Okay, thank you.
Okay. Okay. But mostly what you'll be seeing that people will be talking about bonus issue fraction, bonus issue fraction, bonus issue fraction. Okay. Let's calculate the bonus issue on the, let's calculate the bonus issue on the 100,000. What will be the bonus issue? 100,000. What will be the shares that will be the bonus issue?
50,000.
Okay, that will be the 50,000. So that will be 1/2 multiplied by 100,000. Okay. So what will be the total number of shares for the 100,000? What will be the total number of shares now, including the bonus issue? That will be 150.
150,000.
Okay. So the total shares now will be 150,000, which is 100 plus 150. Okay. All right. Let's come here.
Then is it 100 plus 50 or 100 plus 150?
Sorry. 100 plus 50. That will give us 150,000. All right. So that will give us 150,000. Okay. Let's come here. This total number of shares, this total shares can also be calculated as 100, okay, plus 1/2, 1/2 multiplied by what? 100,000, isn't it?
That's correct.
Okay. So can we say that this is the same as 100,000 plus 100,000 divided by 2, isn't it?
Yes.
Okay.
Yes, please.
Let's do small mathematics here. Okay. The LCM here is what?
1.
It's 2.
It's 2, isn't it?
Oh,
Okay. Oh, don't worry. This is not mathematics.
That's 1.
This is not math class. The LCM is 2. The least common multiples. Multiples of 1 is 1, 2, 3, 4, 5. Multiples of 2 is 2, 4, 6,
6.
8, 10. So among their multiples, which of them is least to all of them? Is 2, isn't it?
Yeah.
Okay. So that is the least common multiple. That is 2. Okay. So 1. This one over here is 1. So we just want to write this one so that they all have the same what denominator, so that we can add them. So this one, we have been saying that this one will go here 2 times, multiplied by this. This will be 200,000, isn't it? Okay. The 2 is already here, so that will now be
100,000.
100,000. Okay. This is not the same as what?
300,000 over 2.
300,000 over 2. Okay. 300,000 over 2. Okay. Assuming we are not writing the 300,000, we can say that this is the same as 3/2 multiplied by 100,000. Do we agree to that?
Okay.
Is that the same?
Yes, please.
Okay. Okay. All right. So someone can say the bonus fraction is 3/2. How do you get a 3/2? This is how the 3/2 is being gotten. The bonus fraction will be, so let's come to the bonus issue fraction. Okay. How did you get a 3/2? This is how you get a 3/2. Look at this place. This is 100,000. Okay. So assuming that we are not using the 1,000. We are not using the 100,000. This is 100,000. This will be the 1, because we are coming to add a new shares to what? To the total of the existing shares. So this will be 1. So we have the 1. Then we come and add half of what? The existing shares. So 1 of the existing shares plus the half of the existing shares. That will give us what? The total number of shares. Okay, so this you'll be having 1 plus 2 divided by 2. That will give you 3/2. So you just multiply the 3/2 on the existing shares. You'll be getting your 150,000. So yes, what I will do is that the easiest way to do this is that just add 1 to your bonus, to the bonus proportion. If it is 1/5, it will be 1 plus 1/5. That will give you 6/5. So that will give you the bonus the bonus fraction. It is very important to know the bonus fraction, because you are going to use it to adjust the previous year's profit, because they will only give you the earnings per share relating to that year. So you go and adjust that. How do we restate that? We turn the bonus fraction upside down. Okay. So what we do is that the bonus fraction will be turned upside down to restate what? That one. So we have 5/6 now to multiply the previous earnings per share. Okay. It will be the previous earnings per share. That is how we restate the what? The question will ask you for comparative what? Earnings per share. You restate that to do your restatement, or if you can get the shares for that particular period or the earnings for that particular period, you can now use your total shares to find that, but that will not always be the case for you. So you always have to restate that particular one. But what I will be doing is that we'll be using the two. So I'll be using the bonus fraction together with the normal bonus what shares also. So I'll be adding it to the existing shares, and I'll also be multiplying with a bonus fraction so that you'll be familiar with the two at once. Okay. Okay, let's look at question number 2. That is about bonus issue there. Let's see.
At 1 April 2015,
Yeah, I think I'm with you.
at 1 April 2015, B Limited had 7 million 1 Ghana cedi ordinary shares in issue. It made a bonus issue of 1 share for every 7 held on 31 August 2015. Its earnings for the year were 1,150,000 Ghana cedis. E Limited earnings per share for the year ended 31 March 2015 was 10.7 Ghana pesos.
Okay.
Calculate the earnings per share for the year ended 31 March 2016, together with the comparative earnings per share 2015 that will be presented in the 2016 accounts.
All right, thank you. Okay, so the bonus issue now, is it on shares that is already in issue, or it is on 2 issues there? We don't have any new shares, isn't it? Okay, so the bonus issue will be made on only the shares in issue. Okay, so these shares were in issue from the beginning of the year, which is April 2015 to what? To okay, that will be to the year 31 March 2016. So the accounting year for the entity is April to March. Okay, April from the previous year to, or April for the current year to March for the next year, or in the next year, that is April to March. So 2015 to 31 March 2016, that will be the accounting year. Okay, the company had in issue the shares of 7 million, which will be doing a full year contribution to the profit. So the bonus issue is made on this particular shares, which is going to be for 12 months rather. So the bonus issue will also be for 12 months over here. We don't pro rata. Okay, so let's go to our earnings per share for this particular period. Okay, so let's come to our basic earnings per share. Basic earnings per share is equal to the profit after tax, or the earnings for the year divided by our weighted average number of shares. Okay, so let's calculate the weighted average number of shares here. So weighted average number of shares. Okay, so you do your April to March, April 2015 to March. Okay, we have our full shares over there. That will be 7 million, isn't it? 7 million times 12 over 12. That will be 7 million again. Let's count to the bonus issue. Okay, the bonus issue will also be what? What will be the bonus issue? What is the proportion of the bonus issue?
One is to 7.
Okay. So that will be 1/7 multiplied by the, so 1/7 multiplied by 7 million. This is based on this one, so it will also be 12 months. Okay. So that will be 1 million. Is that correct?
Yes.
Okay. So that will be 8 million. Okay. Someone who is using the bonus fraction will just have something like this. So the person can also calculate the alternative calculation for that one. The person will just have the April to March. The April to March over here is 2015, April to 2016 March, full year. So the person will do, what will be the bonus fraction? Would that be 8/7?
8/7.
Okay. So the person can do 8/7 multiplied by the 7 million. The person will also be getting 8 million, isn't it? Okay. So that is that. There is no problem with how the two of you are going to be getting it. So we have the basic earnings per share to be, what is the earnings for this year? 1 million.
1,150,000.
So we have 150,000 divided by 8 million. Okay. What are we having?
One 0.144.
What? No, change it to pesos.
pesos.
14.3.
14.38 pesos. Okay. So 14.38 pesos. Okay. They are asking you to do the what? To do the restatements. So you count to basic earnings per share. So the restatement, which will be 2015 year. Okay. What you do is that, what is the earnings per share given to you there?
That's 10.7 pesos.
Okay, 10.7 pesos. So what you do is that you now turn your fraction upside down, your bonus fraction upside down. 7/8 multiplied by 10.7 GP. How much are you getting?
12.2 pesos.
Is what?
12.2 pesos.
No, it cannot be 12.
9.3.
9.36.
Okay. 9.36 GP. Okay. You can also calculate this like this. The alternative calculation for 2015. Okay. All right. Can someone give me the earnings for 2015 based on the information that we have? What will be the earnings for 2015? Looking at the information that we have, what will be the total earnings for 2015? What will be the total earnings?
It's the any times the number of shares.
Is the,
Any per share for that year times the number of shares.
okay. So we'll be having the number of shares, which is 7 million multiplied by 10.75 pesos. What are you getting?
$74.9.
Okay. Your 74.9 over there. Change it to Ghana city. I'm getting 749,000.
Yeah, 749.
Okay. So 749,000. Okay. Okay. But the question is, our basic earnings per share, our number of shares should have been what? What should have been our number of shares that would have been used for the calculation? It should have been 8 million. Okay, the bonus
Yes.
issue, the bonus issue affect it because the bonus issue will affect the shares from the time that it has been issued. Okay, so that would have been 749,000 divided by 8 million. Okay, so we include a bonus issue. What are you getting?
$0.936.
Okay, so 0.936. Okay, but what is going to happen is that the question will not always give you the information for you to be able to know what should have been, or for you to know the number of shares that we are used to calculate the earnings per share for the previous year. Okay, so the best way is that, or the easiest way is to find a bonus fraction and adjust it. Turn the bonus fraction upside down. Because the question, this should have been calculated using 8/7, but we didn't use that. So what we are going to do is that we are going to reduce it by having 7/8. So the fraction, the amount that we have gotten over here, we assume that it has been calculated taking into consideration the bonus fraction, which is 8/7. But now we want to reduce it. We have to turn the fraction upside down to do that. But if you have access to the information to know your earnings per share for the previous year, then you now calculate your new earnings based on the bonus issue, because the bonus issue will affect the 7 million, because the 7 million has been in existence for some time now. Okay, so that is basically about the issue about the bonus issue. Okay, let's come to the right issue. Okay, so for the right issue, what is going to happen is that the right issue will always be, please, if you have share splits. Okay, let me talk about a share split. Okay, share split is a situation where we want to increase the number of shares. So what we do is that if the shares are issued at 1 cedi, okay, before we move on to the right issue, okay, the share split is also treated like a bonus issue. Have that in your mind first. If there is a share split, the share split will be treated as a bonus issue. It will be treated in the same way as a bonus issue. What do I mean by it will be treated at the same? So maybe we have 100,000 shares which are issued at 1 cedi. Okay, we have 100,000 shares which are issued at 1 cedi. Okay. We have 100,000 shares which are issued at 1 cedi. All right. But what is going to happen now is that we want to increase our number of shares. So we want to increase our number of shares so that it can also reduce our earnings per share, because we know that the shares is the denominator. So if the denominator is higher, it is likely that the resultant for whatever you are going to be calculating will be will be low. Okay, so what we do is that a company can decide to now do what we call a share split. A share split is not going to increase the total value of the shares in terms of money. It's not going to increase it, but it will increase the number of shares. So what we do now is that we are going to split the 1 cedi into 50 pesos. So we assume that the shares has been issued at 50 pesos. So if the shares have been issued at 50 pesos, our number of shares will now move to 200,000. Okay, but the value will still be 100,000. Okay, because this, if you multiply, you still be having 100,000. So what we do is that we now change the value per share. We can split it. We can do it, maybe we want to do it 25 pesos. So it means that this will now be splitted into 4. So if this is now 25 pesos, it means that our total number of shares will now be 400,000. So we do the share split to increase the number of shares. Okay, so the question will tell you that the company has done a share split by reducing the value. So if they have done a share split by reducing the value, okay, the share split will be treated as a bonus issue. So if we are doing it on the 7 million shares, the question that we have looked at right now, we're doing it on the 7 million shares. All right, what we do is these shares are issued at 1 cedi. Okay, so our value is 7 million. So if you are now splitting the shares to 50 pesos, then what will happen is that the number of shares will now increase to 40 million. So this particular share split will affect this particular shares from the beginning of the year. So the share split, which is 7 million, will be treated as if it's a bonus issue for that particular year. So for this year, the total number of shares that we are going to be using to calculate will be 14 million. It doesn't matter when the share split is done. As soon as it is on a share that has been in existence for the beginning, it will be like a bonus issue on that particular share. But if we have issued shares for 6 months, after the 6 month offer, we issue shares for January okay, let me use December and January. So we have shares 7 million from the beginning of the year. Okay. And July 1, we issue additional shares. The share split was done maybe after the new issue. So the share split will have effect from July on the new issue. So that will be pro rata using 6 months. But if the share split was done before the new issue, the new issue was not there before the share split. So it will not have any effect on the new issue. So the share split, we will also go back. We also go back and do what? And do our computation as if the share split was there in 2015. How do we adjust that? Let's come here. What is the what? What is the share split ratio? We have 7 million. It is now 14 million. So what will be the share split ratio?
1/2.
No, please. If you want to get this one straightforward, would that be 2/1 multiplied by? Oh, the ratio is always calculated on existing shares. Okay.
Okay.
Okay. So we have the 2/1 multiplied by 7 million. Is that correct?
That will give you 40.
Okay, so that is correct, isn't it? All right. So if you want to reverse this, it will be 1/2 multiplied by your earnings per share for the previous year. Okay. So
Please, sir,
yes, please.
can you go over that place again? Where do you get the 2/1?
We have 7 million. It is now 14 million. So it means that we multiply the 7 million by 2 to get our 14 million. All right.
Okay.
All right. So that is about a share split. Okay. So you should always have that in your mind. All right, let's come to rights issue, and maybe we stop on the earnings per share for now, and diluted earnings per share will come maybe tomorrow, because let's look at the time. Okay. Okay, what you have to know about a rights issue is that the rights issue will be done at a price. But what will happen is that the price will always be lower than what? Than the actual market price. So it will always be issued at what? At a discount. Okay, it is going to be issued to our existing shareholders. So we want to encourage them to what? To purchase the share. So the shares will be issued to them at a new or at a price lower than what? The current market price. Okay, so these shares are going to be issued. Bonus issue does not bring in money, but a right issue will bring in a small amount of money, but it will not be the full amount of money. Okay, so the right issue is done to the existing shareholders in the proportion of their shareholding, but this will always be done at a price lower than what? Than the market what? Value. Okay, so the right issue will always consist of a bonus issue and will also consist of a market value issue. Okay. So it will also consist of some of the shares will be done at a market value and some of them will be done at a bonus issue. Why are we having the issues of the bonus issue there? Because the share price will not be the same as what? As the actual value at the time of the issue. So what we do is that we try to what? Look for the number of shares that represent the bonus issue and the number of shares that represent the what? The market value issue. How do we do that? You have to calculate what we call the theoretical X-right price. Okay, we always calculate the theoretical X-right price. What do we mean by theoretical X-right price? Okay, let's come here. We have shares. We have existing shares. We have existing shares, which is currently 300,000 by trading at 2 cedis each. Okay. Now we have done a right issue. The right issue too, they will give you the proportion. We are doing a right issue at 1.5 or 1 cedi 50 pesos for what? So the shares will be at a proportion of 1:2. Okay. Okay. So can we calculate our value of the firm or value of the company now after the right issue? Okay. So before the right issue, what would be the capital value? What would be the equity value that the company will be having before the right issue?
600.
That would be 600,000. Okay. So that would be 300,000 at 2 cedi. That will give us 600,000, isn't it? Okay. But the right issue has now been done. So since the right issue has been done, it will bring in additional money. Okay. So what is the money that it will be bringing? How many shares are we giving to the people at 1 cedi? 1 for 2.
1 for 2.
150,000.
So that will be 150,000 at what?
1.5.
Okay. So what will be the total value there?
125,000.
Okay. 225,000. So what will be the value of the company after the right issue?
What's the total share, sir?
825,000.
825,000. Okay. What will be the number of shares, the total number of shares?
Okay, 4,500.
That will be 450,000.
450, yeah.
Okay. Okay. So then the new value of the firm is now 825,000, but it is what? 450,000 shares that are giving you that value. So what will now be the value of a share? What will be the price of a share now? How do we find value of a share?
We divided 825
825,000.
Okay. Okay. So it is 450,000 shares that are giving us that one. So how much are we going to be issuing one share to get the 825,000? What are you getting?
1.8.
1.83, isn't it?
Yeah.
Okay. Okay. But what is happening? Our share price was what? 2 cedi, isn't it?
That's correct.
Okay. But the shares that we are getting right now, okay, these shares should have been issued at 1 cedi 83 pesos. Okay. These shares should have been issued at 1 cedi 83 pesos, but they are issued at what?
2
1
cedis.
cedi 50 pesos.
It's not 2 cedis. The right issue should have been done at what? 183 pesos, isn't it? Okay. But this has been done at 1 cedi 50 pesos.
50 pesos.
So what is the amount that is left?
The difference,
The difference is what?
0.33.
Okay. So the 0.33 is the bonus figure or the share price for the bonus issue. So what you do
Oh, okay.
is that this your shares supposed to be for 1 cedi 83 pesos. Okay. So the market value is 1 cedi 50 pesos and the bonus issue is 0.33. So you can share these particular shares in the proportion of the two. So 0.33 will be for the okay. So let me show you how what we have done over here is what we call a theoretical XY price. Okay. That's what we call the theoretical XY price. This is calculated on unit basis. So you look for your value. This is calculated on total basis. You look for your value after the right issue. That is what we call the theoretical XY price. What is the price of the shares after the right issue? That's what we call the theoretical XY price. This is calculated on total basis. But mostly you'll be calculating this on unit basis because the question will be giving you unit items. So let's look at the units, how you are going to be calculating the theoretical XY So you come here to existing shares. Okay. We are doing it on unit basis. Okay. How many of existing shares are we bringing for one new shares? How many of existing shares are we bringing for one new? The right issue is 1 for 2.
Two for one.
Okay, so we are bringing 2 at a price of what? 2 cedis, isn't it?
Yeah.
Okay, so you come to the right issue. The right issue, you'll be giving 1 share at a price of 1.5. So that will give us 1.5. We have 5.5 against what? 3. So your theoretical XY price, theoretical, okay, your theoretical XY price will just be the value over here divided by this one, like the way we did the first one. Okay, you should be getting 1.83. Okay, is that correct?
Yes, please.
Okay, let's come to how we find a right issue fraction. Okay, how do we find a right issue fraction? The right issue fraction will be our cum right price, which is the share price before the right issue, divided by the theoretical XY price. So the theoretical X right price. Okay. So our share price before the right issue will be the 2 divided by 1.83. That is the fraction that we have. Okay. So for you to find a bonus issue element, this is what we do. All right. So for you to find a bonus issue element, what you do is this. You come to your existing shares. You want to find the number on the existing shares, but this is going to be a problem for you. So I'll show you another way of doing this. You have your 300,000 shares multiplied by 2 over 1.83. What are you getting as a total? What are you getting as a total?
$327,860.
Okay, 327, 86.
868.85.
Okay, let's just make it 869. Okay, all right. But what is the shares that we have at the beginning of the year? It was 300,000, isn't it? Okay, it has now moved to what? 327,000. So what is the increment in the share? The increment in the share over there is the bonus issue. So that will give you 327,869 minus the what? The 300,000. So we now have 27,869. Okay, that is the bonus issue in the shares that you have issued. So 27,869 out of this one, it is a bonus issue. So the remaining shares will be for market value. Okay, what I've said first is that this share should be issued at what? 1 CD 83 pesos, but they have been issued at 1.5. It means that a portion of it has not been what? A portion of the amount has not been received, and that portion is the bonus what? Issue element. So you can also find this particular figure like this by having the bonus issue element, which will be 0.33 divided by 1.83. So the new share should have been issued at 1.83. That is the value of the shares. What are you getting? 2786 something. Yeah,
Sir,
you are getting 27 something, isn't it? 2709
049.18.
is because of the approximation that you have done. Okay. You should have been getting the same thing like 27869. So you can use any of the two, but I will be doing all the two at once. All right.
Sir,
Yes, please.
please, I'm confused with the existing shares. Why you use the 300 with the cum right and the theoretical right price? I'm confused there.
We want
Is
to
it
know,
that you wanted to find the existing?
you can continue.
I was asking whether you wanted to find the existing after the right issue or
We are looking for the bonus element in the right issue.
okay.
Okay. The right issue will always be a full market value and a bonus issue. So we are looking for the bonus shares. So the bonus shares will be the 27,869. So out of the 150,000 shares, 27,869 is for bonus issue. So the remaining one will be for the market value. So that is what you are going to be prorating. Okay. Okay. All right.
But the differences you are having here, if I look at it like as you did the first time, when you take the X right figure, the one that we calculated 1.83
Yeah.
out of the price they used to issue, the normal price, which was the 1.5, you will get 0.33.
Okay.
So if I multiply the 0.33 by the 300,000, I don't know whether it's correct.
0.3 multiplied by
The 300,000,
what are you getting? You're getting 99,000.
99.
No, that is not correct. Okay. The 33,000 is related, the 0.33 is relating to, it is these shares that we have to issue that 1.83, isn't it?
Yes,
It is
please.
the 150,000 that we have to issue as 1.83, but this year's has been issued at 1.5, isn't it?
Yes, please.
Okay. So it means that there is what? 0.33 element, isn't it?
Yes,
Okay.
please.
This 0.33 element, the company is paying it themselves. It means that they are converting some of their retained earnings to cover the what? The difference over here. So this is the shares that we have issued to you, but the actual value should have been 1.83. So this total share should be issued at 1.83. Okay. So if you are receiving 1.5 out of the money, so how many shares are you issuing at 1.5? That's what we want to look for. So what is the shares that have been issued at 0.83? Because the shares should have been 1.83. So these all shares should have been 1.83. Now, you are using your reserves to cover for this one, and you are using market value for this one. So what portion of these shares will be for the reserve? What portion of these shares will be for the market value? That's how we do it. All right.
Okay.
But that is an extraordinary thing. Then what you are going to be doing always is this one. You find your right issue fraction and multiply by the existing shares. That will give you your increment. So you see a different value over here. So the difference between the existing shares and the new share is the bonus issue. Is the bonus issue. Please let's pick a question so that I'll demonstrate what I'm talking about there. So how can I get a question on a right issue? Okay, let's look at question number 8.
Question 8. Garfish had profits after tax of 3 million in the year ended 31 December 20x7. On 1 January 20x7, Garfish had 2.4 million ordinary shares in issue. On 1 April 20x7, Garfish made a 142 rights issue at a price of 1.4 Ghana cedis, when the market price of Garfish share was 2 cedis. Required, in accordance with IAS 33 earnings per share, calculate the basic and the diluted earnings per share.
Okay, for the diluted earnings per share will be same as the basic, so forget about that one. All right, so let's come here. So the profit for the year is what?
3 million.
3
Okay,
million,
okay. The company has how many shares in issue?
2.4.
Okay, from the start of the year, isn't it?
Yeah.
So on 1st April 2x7, Garfish made a 142 right issues at a price of 1.4, when the market price of Garfish shares was what?
Was 2.
Okay. So what you do is that you have to find the bonus element. So we are going to be looking for the bonus element in the what? In the right issue. Okay. So let's come to the earnings for the year. Okay, so maybe I can use the example to explain whatever I want to explain. So earnings for the year will be what? 3 million, isn't
3
it?
million.
Okay. Shares in issue was 2.4 million. So the right issue was done. Right issue was for what? 142, isn't it?
Yeah,
At a price of what? 1.1 cedi,
40 pesos.
40 pesos. Okay. So our basic earnings per share will be calculated as the earnings divided by the weighted average number of shares. So let's go and calculate the weighted average number of shares. Okay. Before you calculate the weighted average number of shares, you have to know the share price after the what? The right issue. Okay, so we always have to do the theoretical extract price. Okay, let's come here. We are going to use the unit approach. So we have the existing shares. So the existing shares, how many of the existing shares are we bringing for a right?
2.
Okay, 2 at a price of what?
2.
1.4.
Okay, at a price of 4 cedis. The shares are currently trading. Before the right issue, the shares are trading at what? 2
2
cedis.
cities. Okay.
Okay, so that is
So we always use before the right issue price.
that is the price of the shares before the right issue. So the current shares are trading at 2 cedis. So that will be always the shares before the right issue. All right. So let's count to the right issue. We are going to be having a right. A right is equal to what? 1.4, isn't it?
Yeah.
Okay. So this will give us 1.4. So this will be 5.4, and this will be 3. Okay. Our theoretical X5 price
1.8.
is 1.8. Okay.
Yeah.
5.4 divided by 3. Okay. So, okay, 1.8. It means that our share price is now 1.8. So the meaning is that these shares should have been issued at 1.8, but they have been issued at 1.4, isn't it?
Yeah.
So it means that we are going to get 0.4 from somewhere to be able to balance, isn't it? Okay. This 0.4 is the bonus issue element. So for you to find a bonus issue, you can go ahead to do your 0.4 divided by the 1.8. The market price will be 1.4 divided by 1.8. The share should have been issued at 1.8. Okay. So what is the shares from the right issue? How many shares are we going to be getting from the right issue? 142. Would that be 1.2 million?
Just 1.2 million.
Okay. So 1.2 million. 1.2 million. What is the answer that you are getting for the two? I'm getting 0.
0.267.
Okay, 0.267 here. And what are you getting over here? Zero point 933.
933.
Okay. Okay, just keep these figures. So let's count to our weighted average number of shares. Okay, so our existing shares will be calculated as the existing share, which is 2.4. The 2.4 will do a full year. So you do 2.4 multiplied by the bonus issue. So we find the bonus issue fraction. The bonus issue fraction will be the existing share price, which will be 2 divided by 1 point, which is the theoretical extra price. This is how the bonus issue is calculated. The fraction, the right issue fraction is calculated as the cum right over the theoretical extra price. So our share price before the right issue is 2 million divided by the share price after the right issue. That is what? 1.8. So what are you going to be getting here?
$2.67.
2 points.
67.
Okay. So you'll be having 2.67, isn't it? Okay.
Yeah.
Let's come here. What was the shares before the right issue? What was-
2.4.
Okay. So right now the share has increased by what?
By
0.27.
Okay. 0.27 or
7.
it should have been 0. What? 0.267. Okay. So if you are approximating this will be 0.7. 0.27 here. Okay. And this will be 0.93. Okay. Is that correct? If we are approximating this.
Yes.
Okay. So I'm saying that, you see, for you to go through this stress, okay, by multiplying this, just know that after the theoretical extra price, this is supposed to be the actual price of the shares. But you issue the shares at the discounted price. So what is the price that you have to add to get the theoretical extra price? You just share the shares from the right issue to the two. That's how we go about it. So instead of you,
Please,
yeah.
what we are looking for is a bonus issue.
Yes, please.
So is it advisable when we get the difference, we just work for the bonus issue and forget about it?
The fraction, isn't it?
Yeah.
Yeah. That's you. The only thing is that is the answer that they want. Okay, so you can work for the bonus issue, but we have a way of doing the right issue that is going to worry you. Okay, because we do it. Okay, we'll be multiplying by the bonus issue fraction. I will do that one too. Okay, all right. So our shares over here is now 2.67. These particular shares will be for a full year. So the bonus fraction will also be for a full year. So we are getting 2.67. Let's count to the market value. What will be the shares that will be issued at the market value? Perfect. The shares that will be issued at the market value will be this one. So the total shares that we are issuing, 1.2 minus what? 0.27. Okay, multiply by, because included in this particular shares is 0.27 for bonus issue. So what will be the shares for the market issue? Okay, that will be the 0.93. Okay, that 0.93, which is a market issue, will have impact on the profit for how many months? The issues were on 1st April. Okay, so
That'll
bonus
be 9 months.
okay, bonus issue will be for the full year. Okay. But the market issue will be for only 9 months. So 9/12. What are you having?
Zero 0.698.
0.6.
98.
Okay.
0.69 0.6975.
Can we 0. Can that be 0.70?
Yeah.
Okay, 0.70. So let's add that to 0.70.
2.970.
Now I'm getting 3.37.
Yeah, 3.37.
Okay,
Oh, sorry.
3.37. So this thing, our earnings per share will now be 3 million divided by 3.37 shares. What are you having?
That will be 89 pesos.
Okay, so we have 89 GP per share. Okay, let's calculate our weighted average number of shares from a different perspective. Okay, let me take this one again. What I'm saying is that whenever you are done with whenever you are done with the theoretical XY price, whenever you are done with the theoretical XY price, find the what? Find the right issue fraction, which will be the market price before the right issue over the theoretical XY price. Multiply it by the existing shares, the shares that you have before, or the shares that you have at the start of the year. So multiply it. If you multiply it, you get an answer, which is 2.67. The shares that you have from the beginning is 2.4. Now it is 2.67. So what is the difference? The difference is 0.27. That difference represents what? The bonus element of the right issue. So if the bonus element is 0.27 and the right issue shares is 1.2, so what is the portion of the shares that have been issued at a market value? You just subtract your bonus issue from it and get your market value of 0.93. This is the shares that are going to have 9-month contribution, because a full market value will have a contribution from the start that they have been issued, but a bonus issue will be like it has been in existence for the start of the year. So that is why you are going to pro rata. It is the market value that you are going to pro rata for 9 months. Okay. And I'm also saying that for you to calculate the bonus issue, you can also ignore the bonus fraction. What you do is that the shares after the right issue should have been 1.8. So the right issue should have been issued at 1.8, not 1.4. So it means that we receive only 1.4. We are not receiving 0.4. Okay. So the 1.2 million should have been issued as 1.8. Okay, so this 1.2 should have been issued at 1.8, but it has been 1.4 against 0.4. So what portion of this particular one are we having from 1.4, and what portion are we having from what? 0.4. So you now share it among them. So the remaining figure over here, which is the increment to make it 1.8, is the bonus what? Value, which is in terms of money. So it will be 0.4 divided by the 1.8 multiplied by the shares that you are getting from the what? From the right issue. That portion will be the bonus portion. So you just come and add the bonus portion to what? To the 2.4, because it will have effect from the what? From the start of the year, and you'll be getting 2.67. The 1.4 divided by the 1.8 multiplied by the bonus shares of 1.2, that will give you the market value. So the market value will have effect on the profit from the date of issue. So you pro rata by 9 months. Okay. We also have another way of calculating the weighted average number of shares, and this is a confusing side, but you pick the one that you are comfortable with. Okay. What you do is that you apply the bonus fraction, which is 2 over 1.8. You apply it on the existing shares up to the time of the right issue. So what we do is that let's go and look for when our right issue is done. Our right issue was done on what? 1st April, isn't it? Okay, so it means that we have done 3 months before the what? The right issue. So we come here, we have our existing shares, or let me just make it January to March. So the January to March, you have 2.4 multiplied by 3 over 12 multiplied by the bonus fraction of 1.8. Okay, that is what you are going to do. 1.8. Okay, maybe this is what we have seen before. Okay, so what are you going to be getting? So the bonus fraction, the
0.67.
the bonus element will affect only the shares that has been issued before the bonus what? The bonus what? Issue. Okay, so that will be 2.4 multiplied by 1 over 4 times 2 divided by 1.8. I'm getting 0.67.
Yes.
Okay. So you come to April to December. April to December, what will be the total number of shares that we are going to be having? We'll be having the shares that we have plus the what? The shares from the what? From the bonus issue. So our total number of shares will be the existing shares plus 1.2, which is the bonus what? The bonus issue. Then this will do 9 months. Okay. What are you going to be having?
Three.
That will be what?
3.
Okay. Times 9.
Hey. Won't you add the fraction?
Which fraction?
Okay, that is the design.
3.3, sir.
2.7.
So you'll be having 3.37, isn't it?
2.7, yes, 3.
That's 3.37.
Okay. So anyhow you do it, but for me, this is going to take your time. Okay. Sometimes you might even get confused with this one. The bonus fraction, the bonus shares will have effect on shares that are being in issue before the bonus issue. So that is why we apply it on only what? The 2.4. Because the 2.4 was there for 3 months before the bonus issue. So the bonus issue will be on the 2.4. But after the bonus issue, there will not be any bonus issue again. So from April to December, there will not be any element of bonus issue because the bonus issue was done on 1st April. It will have effect on shares from the beginning to what? To the time of the bonus issue, which will be January to April. After April, no bonus issue over there, unless bonus issue has been done again. Okay, so you can also do it from this angle. But for me, this is what I'll be using. Okay, for me, I normally use the finding the bonus element separately, adding it to the 2.4, and I will apply.
Sir,
Yes, please.
it's like the one you said will be confusing, rather looks simpler than.
Yes.
It
That one.
is because
This
it's because the bonus issue is only one. Okay. Okay, it's because the
this one
bonus
looks
issue is okay. So pick the one that you want. All right. You have your, but you
You
can
said it's because the bonus issue is only one.
yeah.
So say, how will you do it if it
you
is
can
more
have
than one?
you can have a right issue, and
Senior, how will you do it? Because if it's 2, how are you going to work on that one?
Yeah, that's what he's about to explain.
no, I'm not coming to explain anything now. I have to go and get the question so that I can use the question to demonstrate. Okay. So
You said we can have.
yeah, you can have a market value before the bonus issue.
Mhm.
Okay, you have a market value before the bonus issue. So the multiplication will be complicated for you. Okay. But what you have to know is that assuming you can have a market value here, maybe the market value will be, let's say the market value rather is April. Okay, April 1. And the right issue will be, so the right issue was from, let me get 3 months. October to December is 3 months, isn't it?
Yeah.
Okay. So 1st October. So this will be full market value Okay, this will be a full market value. Okay, and this will be, so the right issue. Okay, let me write the date here. So we have October 1. That will give you right issue. Okay. Okay. So let's say that the full market value was 3 million. No, it was, let's say it was 1 million shares. Okay, the right issue is now down 142. Okay. You see that the bonus issue is going to be affecting two figures here, isn't it? The
Yeah.
bonus issue was on 1st October. So it will affect the shares at the beginning. It will also affect the shares at what? At the end. Okay. So the question will always give you the right issue amount. So they'll give you the right issue amount and they will give you the market price before the what? The right issue. So you have to find the theoretical price, taking into consideration the two. Okay. So they will give you the value before the right issue and they will give you the right issue price. Okay. So you have to find the right issue fraction. If you want to find the right issue fraction, let's assume that the right issue fraction is 1.8. Okay, it's 2 over 1.8. Let's assume that it's the same figure here. Okay. If you want to calculate your weighted average number of shares now, you'll be having, what you do is you'll be having January to
April.
okay, January to April 1. Okay, it will be done on the shares one by one. So January to April 1. So January to April 1. January to April 1. That will be January to April. And that will be, you have your 2.4 multiplied by 3 over 12 multiplied by 2 over 1.8. Okay. Then you count to April to what?
Over.
April to October. Okay. April to October. April to October now will be, what will be your value? What will be your number of shares from April to October?
3.4.
That will be 3.4. Okay. So we have 3.4 multiplied by 3 over
6 over
12. No, it's not 3 over 12. That will be 6 over 12 rather.
6 over 12.
So 6 over 12 multiplied by 2 over 1.8 because the right issue was done on 1st October. Okay. Then from October to December, your total number of shares will now be what? Your total number of shares will be what?
Okay, 2.4 plus 1.2.
3,
No, please.
3.4 multiply 1 over 2 plus 3.4. It will be 5.1.
Okay, that will be 5.1. Before the right issue, we have a share of 3.4. The right issue was done October. So we have 2.4 plus the 1 million. That will give us 3.4. Okay, so the right issue will be done on the 3.4, which will be multiplied by 3 over 2. So we are getting 5.1.
So 5.1, yes.
Okay, so this 5.1 will now be for what? 3 months. Will now be for the 3 months. Okay, this one will now be for the 3 months. So this is how you are going to do it. You can see that it's somehow yes, it's somehow complicated in your eyes. Okay, but if we are looking at the one that we spoke about the first time, this is what we are going to be doing. Okay, very simple. You look for January to December. So you find the right issue on each of the shares one by one. Okay, these shares will be there for what? Will be there for a full year. So January to December, you have 2.4 multiplied by 2, 1.8. Okay, what are you having? You'll be having your 2.67, isn't it? Are we having 2.67?
Yes.
Okay. So the bonus fraction, the bonus issue on this one is 0.27. That is the first one. Okay. Let's come to our bonus issue on this particular amount also. Let's come to the bonus issue on this particular amount. So the April, the shares that have been issued on April, we want to know the bonus issue on it. We want to know the bonus issue on it. Okay. We want to know the bonus issue on it. All right. Let's come to this one. So this is a full year, which is 0.27. Let's count to April to October. April to December rather. So April to December. April to December. Okay. The April to December will be what you are going to be having is that the April to December, you go and do your calculation for April to December. That will be for 9 months. So you do your 1, which is the 1 million shares. So you have your 1 million multiplied by 9/12 multiplied by 2/1.8. What are you going to be having?
Zero point eight three three.
0.833, isn't it? Okay.
Yes, sir.
So 0.833. Okay. The question is, if there is no bonus issue, if there's no bonus issue, what would have been the shares for what? The April, the full market value, what should have been the share? It should have been 9/12 multiplied by 1 million, isn't it?
Yes, that should be it.
That should be it. So what should have been the answer?
So now divided by 0.75.
0.75, isn't it?
Yeah.
Okay. So 0.75. Now the value is what? 0.33. What is the difference?
Zero point zero eight three.
So 0.083. So that is the what? That is a bonus element on. That is a bonus element on the what? On the April also. So you just put the two together. So 0.27 plus 0.083. Okay, I'm getting 0.353. Is that correct?
Okay. Yes.
Okay. So the question is, what is our share from the right issue? It is 1.7, isn't it? The right.
Yes.
Okay. So out of that right issue, 0.353 were for what? Bonus issue. So you find the difference over there. The difference will give you the full market price. And that full market price will be 3 multiplied by 3/12 multiplied by that, because it will have effect from October to December. So that will be the market value from the right issue will be for only 3 months. Okay. So you do that particular one. But the one that is okay for you, you pick that one. Okay.
Hello,
Listen,
sir.
where do you get the 5.1?
5 points.
October to December figure.
Yeah, we have that before the right issue, we have 3.4.
Yeah.
Okay, so have the right issue is 141.
Oh,
So we
okay.
have 3.4 plus the right issue 1. That will give us the total shares from that date. Yeah. Yeah.
Hello, sir.
Yes, please.
Please, I would like to find out. At times, you will see a question like they will give you the initial or the share at the beginning. They also give you a bonus issue. Then, after the bonus issue, the right issue too will come. So, in a case like this, I multiply the bonus issue with the right issue fraction.
They are all having bonus elements. So you multiply all the shares that were there before the two have been done. So you multiply them one by one. So if we have a bonus issue followed by right issue, the bonus issue will be having a bonus issue. So that will multiply the first shares that were there before the bonus issue. The right issue is still having a bonus issue. So it will be a bonus issue on bonus issue. So you multiply the existing shares by the two fractions.
Okay, so I will multiply the right issue to the existing and the bonus as well to the existing.
Yes, you are
That is
issuing bonus on
at the
bonus.
genuine one.
Yes, please.
Okay, so the bonus will not, the right issue will not affect the bonus.
It will affect. If you are doing the right issue first, okay, let's assume that you have shares, which is 3 million. Okay, you have share values, which is 3 million. Okay, and the bonus issue on this one, or maybe there's a right issue and the bonus issue element in the right issue is 1 million. Okay, and you have done bonus issue again after the right issue, which is 142. Okay, the shares before the bonus issue was what, 4 million.
4 million.
Okay, because there was existing shares of 3 million, but there was a right issue of 1 million. So this right issue will increase this one to have a total share of what? 4 million. Okay, but before the bonus issue, we have what? 4 million shares. So it will be a bonus on bonus. So this will also attract the 142. This will also attract the 142. So if you are multiplying, it will be 3 million multiplied by, let's say, that will be 143. So that will be 4/3 multiplied by 3/2. This is how you are going to find it. So that at the end of the day, you'll be having 6 million. I'm sure that will give you 6 million. Okay, you can check and see whether it is 6 million.
Okay.
Okay. Okay. So 3 million multiplied by 4/2. That will give you 6 million. So that is how it works. If there's a bonus issue and a right issue, it will be a bonus on bonus. Okay. So that is it. Okay. So we are going to do diluted earnings per share next week. Then we solve examination questions on the
Next week or tomorrow, done.
tomorrow. Sorry. So tomorrow. So we pick examination questions where you'll be having complicated issues. Okay. But this is just an introduction. Sometimes I can put all of them in one question for you. How do you go about it? So we look at that.
That for corporate reporting.
Who told you?
I'm lying.
Okay. So this one, they are now raising the standard of the question. So anything can happen. Okay. But the corporate reporting one will be more advanced than the financial reporting earnings per share. All right. All right. So
Please,
yes, please.
please, can you